This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
When we do a little bit bigger deals and we do syndicate it, our strategy, we'll hire syndication lawyers, do the PPM, go through all the legal compliance stuff, and then we'll generally take about 50% of the deal for ourselves. If it has good cash flow, then that's the deal. It's just a 50-50 split.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. Hal Elrod once said, the moment you accept responsibility for everything in your life is the moment you gain power to change anything in your life. And now this is something I personally take to heart. If you keep your positive mindset and realize that every day above ground is a good day, you'll realize that there are no bad days. Well, our next guest knows all about this. He currently has over 300 residential units and multiple commercial properties. Now, before he did all this, he had to overcome some significant health and financial issues, but eventually he was able to retire within 7 years of making it a personal commitment to do so. Now, and even though he's graduated with a law degree from Michigan State, he found that multifamily was his key to prosperity. So he decided to quit his 9-to-5 job and make it his primary focus. Today, we'll share why he believes that real estate is among the best assets to own, especially during real estate or during inflation like we have right now. So with all that, I'd like to welcome Jeffrey Holst. So Jeffrey, buddy, thanks for coming on, man.
Yeah, thanks for having me. I appreciate it.
Yeah,
excited to be here.
Yeah. No, I'm glad you're here. Now, guys, if you like what Jeffrey has to say, you can reach him via his contact page at jeffreyholst.com. Okay, Jeffrey, go ahead and tell listeners a little bit about how you got your start in all this.
Sure. So you alluded to health problems. So I was a bankruptcy attorney. That's what I did. And I always was interested in real estate. My parents had a few residential properties when I was a kid. And I did things like, clean outs and stuff like that when I was 14 or 15. But I always wanted to buy real estate and I didn't do it. I decided to go to law school, became an attorney. And then I got hit with a terrible situation. I ended up finding out I had leukemia in 2008. I wasn't financially ready for it, and it forced me into personal bankruptcy in 2010. So I was the bankruptcy attorney who filed bankruptcy, and at that point, I still thought I was probably going to die from leukemia. And I thought, okay, I'm going to take a job, and I'm going to take whatever money I get, and I'm going to start investing in real estate. So it kind of motivated me to do that because, one, I didn't know how long I would have, and none of us do. But also, I wanted to make sure my wife was going to be okay. I mean, we kind of made an informal deal that, she was going to work really hard while I was in law school. And when I got out, she wouldn't have to work as hard. And if I died, I wouldn't be keeping up my end of the bargain. So I thought I better figure this out for her. And fortunately, I didn't die and I figured it out. So it's worked out well for both of us.
Excellent. So it's interesting. The motivation was to get some cash flow, it sounds like, too, right? Because you knew that it was going to be, you're going to have tough times ahead and you won't be able to really work as an attorney. And that passive income is really what you felt you needed to have to see you through, right?
Yeah, I mean, so it really came down to I wanted to create some kind of residual income so that if something did happen to me where I couldn't make money in the future, that we would be okay. And so it was about buying back my time. And I think that's one of the big secrets to life, right? Figuring out how to buy back your time as soon as possible so you can live life on your own terms. And so with real estate, it was one thing I knew that it was predictable. I mean, that's really what it came down to, is it was predictable cash flow. And frankly, if I'd started when I was first interested in real estate, buying real estate, when I got sick, I wouldn't have ended up bankrupt. I would have had cash flow to pay my bills and I would have been fine.
Right. Would you say that building that passive type of income is something that is largely ignored in the educational system then? Because, I mean, I honestly didn't hear anything about that until I was well in corporate America. That was even passive income wasn't even a concept. And when I heard about it, it was kind of like, it was absurd. What do you mean passive income? What are you talking about?
No, I mean, listen, I went to private schools, but we never talked about it there either. And, I know a lot of the people that, my parents certainly had some, passive income from their rentals. And my dad had run several small businesses his entire life and had set them up in a way that he didn't have to be day-to-day involved in them. So, I had exposure to it, and I still never heard it at school. And I would have been more sensitive to it. Never even really thought about it until, Rich Dad, Poor Dad came out right after I got out of high school. And that's when I started going, oh, yeah, this makes sense to me. But even then, I didn't do anything with it, right? That was the main thing. It's like, it's one thing to be exposed to the concept of passive income, but you also have to take action to create that passive income.
Yeah. Yeah. So tell me a little bit about your journey then. So when you made that commitment, and I know it took you like 7 years to really get to a point where you felt like, I don't really need to work as the attorney anymore.
Yeah. So I mean,
what was that like?
Yeah. So I actually quit practicing law in 2011, or really late 2010. And I took a job working for a transportation company. So I moved from Michigan to Tennessee at that point. And I went to work, regular 9 to 5 instead of working for myself because I wanted better benefits. But because I had a law degree and an MBA, I had a pretty decent salary. And I took all of my bonus money and put it into real estate at that point. And so I did that I'd committed to work for them for 2 years, and it ended up being about 6.5 years. And then they were selling to a bigger company. And I was like, man, I don't even really like working for a small company. I definitely don't want to work for a publicly traded company. And so they gave me an option of like 6 months salary or, a job in the legal department of this publicly traded company. And I was like, yeah, I'm out. I'm definitely going to see what I can do. And I originally thought I would have to find work, but then I started looking at the fact at that point we had about 50 single family homes and condos and maybe a couple duplexes. But I kind of went, okay, I can, with 6 months salary, I can sit back for a minute and decide what I want to do. And that was really a game changer for me, because I suddenly realized that after a few months, I still had the same amount of money in the bank as I had at the beginning of the severance period. And so I went, okay, well, I don't have to go back to work. So now what do I want to do? And then I was able to completely change my real estate business around and figure out a way to really accelerate.
Nice. So now what sort of deals were you getting into then at first? Like what sort of deals and what sort of financing, what sort of terms were you getting on that?
Yeah. So, I mean, if we flash back to when I first filed bankruptcy, I couldn't get financing at all, right? We were fortunate it was 2011, so stuff was really cheap. The first deal we bought, we paid cash for it. It was $30,000 for a condo in a nice suburb of Detroit. And we still own it. It's probably worth $150,000 or something like that today. And at the time it rented for like $600, but now it's, I think we're getting $1,300 or something for it. So pretty solid return on that. If that was the only thing I did, I would be, happy I did it. But when I quit working, that's when I started getting into multifamily. The first deal I did was a 12-unit value add deal. It was a C-class building in a B-class area, and we fixed it up. And once we got the rents up, we were able to refinance it and pull out all of our money. And then I just started repeating that strategy at that point, because I was like, whoa, we bought this building for $600,000. And then when we refinanced it, it appraised at $900,000. I actually sold it last year after owning it for just about 4 years, and sold it for $1 million to like $1.2 million. So, basically double the money, and we 1031'd into a retail shopping center at that point. So
beautiful. Did you syndicate that one, or was that?
No, that deal actually, it was just my dad and I. Nice. I'd gotten that severance, and since I realized I wasn't like going backwards, I actually took my severance and bought half of it, or I think it was slightly 40% for me because I didn't have quite half the money, and my dad bought the rest, and we've just stayed in that deal. So
nice. So nowadays, Now, fast forward to today. How are you putting your deals together today? Are you using financing? What sort of financing are you using?
Yeah, I mean, so on that deal, we put 20% down and got bank financing, and I've used that model over and over again since then. Now we have some pretty good relationships with local banks. So on our local stuff, we're actually able to even get interest only periods and construction loans and stuff like that to sort of apply our strategy of doing that value add.
Hey, Agostino here, and I would love to connect directly with you. Text the word books to 844-428-1344 to receive weekly book recommendations from me.
But I mean, every deal is a little different. It's I look at the deal and say, okay, how does this work? And how much money do we need? And then I try to figure out how I'm going to get that money. Because I think that's if you go all the way back to the Kiyosaki book, right? It's not I can't do this. It's how can I do this? And so if you just keep asking yourself how to do it, you figure out a way to make it work. And that's been my strategy. I mean, everything I've done since the very first real estate deal I did is I've done with partners. I've never done anything completely on my own. I don't usually put together big partnership groups and syndicate. I mean, we do that once in a while. It's usually one or two people, and we figure out a way to make it work for everyone.
Nice. So now let's talk a little bit about that. So how do you put your syndications together then? It sounds like they're always different. They always change. How do you put them together? Does it depend on the deal, the asset?
I mean, because we're doing smaller deal size than most of the syndicators, a lot of times we don't syndicate, right? It's hard to syndicate a deal if you need $300,000. It just doesn't work math wise. I mean, you really need to have one partner if you're doing a deal like that, or do it on your own. But when we do a little bit bigger deals and we do syndicate it, our strategy, hire syndication lawyers, do the PPM, go through all the legal compliance stuff, and then we'll generally take about 50% of the deal for ourselves. If it has good cash flow, then that's the deal. It's just a 50-50 split with our investors. If it needs to, if it's maybe going to be a little light on cash flow or something, we'll put some kind of pref in it to make it work for them, but we still try to keep more of the equity. Our goal is to accumulate equity. I'm not trying to make a ton of money on syndication fees and stuff like that. And we charge them to cover our cost, but that's it. It's not I'm trying to build a portfolio of real estate. So however I have to do that to structure it so that I get a good chunk and at the same time provide a return that's attractive to my investors. And you can do that in what I do. When you buy a 20, 30, 40 unit building, it works. If you buy a 250 unit building, you're going to have to do the splits a little different, but you're also going to be taking less risk, right? Because we're primarily dealing with stuff where we have full personal recourse. Our investors don't, but we're signing personal guarantees on notes and things like that to make those deals work. If you're buying a 300 unit building somewhere, and you're not taking personal recourse on the deal, then you don't need to be compensated in the same way. You can spread the risk differently.
That's right. So now, what sort of deals are you doing then? Are they? And we talked a little bit in the green room about it. They're C class, B class type deals, that kind of thing.
Yeah. So I mean, our main thing is we do. We try to buy the better C-class stuff in B-class areas and fix them up and turn them into B-class buildings. So we get the benefit of the increased net operating income, but also the benefit of a decreased cap rate at the same time. If we can find that deal, I'm going to do it every time.
Right. So and that leads me to the next question, right? You just said if you could find that sort of deal. I mean, right now, listen, you and I are in the same wavelength, love real estate, but it's tough to find deals these days, it sounds like anyway. I mean, you really have to look really hard.
Yeah.
Where do you see the future of real estate heading? What do you see taking place?
Yeah, so I mean, you alluded to this in the intro, right? There's competing issues, right? One thing is, there's a ton of money that's been printed in the last few years. And we've seen inflation 7.5%. If you believe what they're telling us, it could probably be more than that. And they're still loaning money to us below the rate of inflation, no matter how you slice it, right? You borrow at 3.5 or 4 or 4.5, and you have 7.5% inflation. It's like they're giving us money for free. Right. So on one hand, it looks like, buy deals that are okay. As long as they cover themselves, you're going to be okay in the long term, because the prices, may go up forever. The flip side to that is it feels a little toppy right now. And it also feels like we could be coming into a recession. We're either overdue for a recession or we're soon to be due for a recession. I mean, we're definitely late in the cycle. There's some debate about this because we actually had a very deep short recession during COVID. And then they changed the definition and said it wasn't a recession after the fact. But if you go by a classic definition, we actually just came out of a recession. So there's like a lot of debate about where the market's going. And I don't know the answer. So I'm trying to be pretty conservative in my underwriting. And if I miss out on a deal, I'm okay with that. Yeah. I'm in a good position though, right? I don't need to grow just to grow. And because I don't run my life on getting more syndication fees. If I don't find a deal, that's fine. I can sit back and wait and see what happens and put some money on the sidelines and make sure I'm getting good deals. And right now that's a lot harder than it was 6 months ago, actually. I mean, the last 6 months have been crazy. Where we're seeing deals going. But rents have been supporting it. In all fairness, deals that I bought 6 months ago look like a home run now, but the deals that I'm looking at right now, the rents have come up so much that they look like they work even though they're 20% more. I mean, if rents are 20% more at the same time, then it still works.
Yeah. Yeah. Now how are you underwriting to limit your downside risk? I mean, are you still looking at those 30, 40, 50 unit deals? Are you pretty much stepping back from those and focusing on alternate asset classes like single family or even industrial?
Yeah, I mean, right now, my main underwriting criteria is that it has to have adequate cash flow and I have to have a clear path to long-term financing. Because, the thing about it is like, if you refinanced or had to sell in 2010 and you bought in 2006, you were in trouble, right? But if you had long-term financing and you could buy at 2006 prices now, you'd be super happy about it. So I feel like over the long term, this is pretty forgiving. So I'm just looking for cash flow as a measure of safety now. The more cash flow, the safer the deal. That's your debt service coverage ratio, right? More cash flow, safer deal. So I try to make sure I have adequate cash flow and some cash reserves and long-term debt. And if it meets those three criteria for me, then that's the kind of deal I'm looking at. And frankly, some of those, I told you in the green room, I just did an industrial deal. I'd never done one before, 100,000 square foot industrial building. I love the deal though. It cash flows, it had long-term debt in place, it's got a stable tenant base. And also I think the rents are below market rents. So, when you consider all of those factors, it's like, this is going to be really, really good long-term hold. And to me right now, because I don't know where the market's going, I want stuff that I'm comfortable holding for a long period of time in case I have to wait out a recession. Yeah.
And now, one thing that some of the guys that did go through that recession, one thing that they did in these longer-term holds is that they would often make sure that their spread of rent on an asset would be enough that they have to reduce rents that they're able to make it through that recessionary period, if you know what I mean.
Yeah.
Right? So meaning that the mortgage payment is $600. Right now you're at 15, but you can still go as low as 800 and still be okay. Be okay, right? Are you applying those sort of metrics these days?
Yeah, well, I mean, I don't think about it that way too much because in the markets that I play in the last two recessions, we saw rents flatline but not decrease. So I don't worry too much about decreasing rents, but I do look at that in my stress testing and say, and in a way, when I say cash flow is a measure of safety, what I'm really saying is the more cash flow, the safer I feel about the deal. And that's the same thing as what they're saying, right? They're saying, hey, if I have to lower rents, I have that cash flow cushion to protect myself. I just don't phrase it quite the same way as them, I guess, but it's the same concept.
Yeah. And I think that now more than ever, it's because that's going to become a more important thing because, hey, listen, you're not the first one to come on here and say that you're worried about what's happening in the economy today and where things are headed. So
yeah, and the sad part about that is too, right? Like the more people that worry about it, the more likely a recession is. So like I want to be out in front of it, but it's also like me coming out here and talking about being in front of the recession contributes to the likelihood of a recession. Right, so I would love to be like, oh, the market's going to go up forever. But the problem is like somebody else is going to come on here and be like, oh no, we're going to go into a recession, and then we're going to end up in recession, and my rainbow face or whatever it's not going to solve me. Like I wish it would work that way, but like unless we can convince everyone, we're going to end up somewhere in a recession at some point. It might be 2 years, 3 years from now. I don't know.
Well, if you talk to any of the brokers, all the brokers will tell you that there's no recession, everything is still strong. And it's like, I don't know, man. I mean,
well, the problem is it's strong until it's not, right? Like, so the real problem is that like the way the market cycles work is that as long as rents are going up, prices go up. And as long as occupancy is above the long-term historical occupancy for that product type, rents will go up. Like that's just the way it is. Occupancy drives rents, and rents going up causes prices to go up. And as long as rents are going up and occupancy is above average, people are excited and they start building new stuff. But the problem is when you start building new stuff, is you add supply, and if you add enough supply, occupancy starts declining. And the thing is, like, if occupancy is historically, like, let's just make up some numbers. If it's normally 95% and now it's 98%, if it declines to 96%, it still looks pretty good, right? But that direction of occupancy is such that we're in a hyper supply period, more supply coming online than occupancy is being absorbed. And at some point, rents are still going up, but occupancy is declining, and we could very well be in that. Now, in most markets right now, that's not the case. So I think we might have a little bit of time before a recession actually hits the real estate market. But that's because real estate's it's a lagging indicator, right? Like usually the business cycle collapses first and then real estate collapses. So while we may have some time, when you're buying an apartment building, you're not planning on keeping it for a year. You're planning on keeping it for 3 to 5 years or 7 years, depending on how your model looks. 3 to 5 years from now, we could very well be in a recession. And so you better have a secondary plan, which is, not have a balloon payment 3 years from now. Because we may have 2 years till the recession hits the real estate market. And in fact, I think it could be even longer. I just don't know how fast and how deep the recession will be. So.
Right. Well, if it's anything as bad as it was the last time, it was 2008, everything came tumbling. I think by 2010, things were finally recovering.
Yeah, and the recovery was long and slow too. To get back to 2007 prices, it took years.
Yes. That's right.
Not 50 years, obviously, because, by 2012 or 13, we were pretty much even in most markets that I follow. And so by 2013 or 14, it was like, pretty solid recovery. And now, of course, like I said earlier, if you could buy in 2007 prices now, you would jump up and down for joy because like we're up, 50 to 100% in most markets from those prices. But It's also been, 15 years.
Yep. Yeah. Now, and speaking of markets, you mentioned that you moved from Michigan to Tennessee, right?
Yeah.
So, what prompted that move, and what's going to prompt your move to Puerto Rico? I heard you're moving to Puerto Rico next.
Yeah. So, I moved here because I got sick. So I'm in Chattanooga still now, but I moved here when I got sick and I took a job in Chattanooga. So it was work related is why I moved here. And, it turns out there were a lot of jobs in Chattanooga. There weren't so many in Michigan at the time. The auto industry was crashing. And so when I moved here, a lot of other people were moving here. So I got to catch a rising tide, when it came to real estate. So it's worked really well as a result of that. Puerto Rico is just, that's more of a personal choice. I'm in a completely different spot now than I was then. Then I was a necessity to figure out what I was going to do. Now I can live wherever I want, and I want to live in Puerto Rico. I love Puerto Rico. It's a beautiful place, but there's also a lot of really interesting things going on. So there's like really big tax incentives to move to Puerto Rico right now. None of them really apply to me, so I'm not moving there for tax incentives, but there's a lot of wealth moving to Puerto Rico from the U.S., which is causing a rising tide. And I think there's a lot of opportunity in real estate, business development, tourism industry. There's just a ton of really interesting things going on there. There's a huge number of cryptocurrency people there. There's a lot of education. People doing export services is a big thing there. So you get a lot of the social media personalities are popping up there. They're moving over there so that they can, sell their courses and stuff like that because they're taxed at very, very low rates and exempt from federal income tax on that kind of work. So.
Well, that sounds to me like a really good incentive to be there. So.
Yeah, and it's fascinating, right? Like you walk around Old San Juan now and you hear people talking about how they're developing cryptocurrencies, and you run into people that bought into Bitcoin in 2012 and have hundreds of millions of dollars because they have 0% capital gains on crypto in Puerto Rico too. So that's bringing a lot of people there for that as well.
Yeah. So
and again, exempt from U.S. federal tax. So as far as I know, only place in the world where you can get super favorable rates as a U.S. citizen and be exempt from federal tax. There's positives and negatives to that, but the big positive to me is that it's creating a situation where there's just a lot of stuff bubbling to the surface in Puerto Rico, and it's going to create, I think, tons of opportunity for people who live in Puerto Rico, for people who are attracted to that sort of thing, and I find it fascinating. It really feels a lot like Detroit did in 2010. Detroit in 2010, people were like, "Oh, I would never invest in Detroit. It's terrible." But then from 2010 until now, it's experienced a tremendous renaissance, and I feel like that's what's happening in Puerto Rico. When I tell people I'm going to move to Puerto Rico, they're like, "Oh, I couldn't live there. There's hurricanes and earthquakes, and their power goes out all the time." Well, all right, fair. Those things do happen sometimes, but they happen less frequently than most people think, and they've rebuilt most of their infrastructure post the last hurricane. And so at least in my condo in Puerto Rico, the power's never gone out while I was there. And I've spent a fair amount of time there. That's not to say it can't, but the power goes out in Chattanooga sometimes too.
It's power goes out. I mean, if you're really that concerned about it, get a generator. I mean, what do you do, right?
Yeah, exactly. So, and like I said, I mean, my place in Puerto Rico has a 2-mile white sand beach with turquoise blue water, and I'm on the 12th floor, and I can see the white sand a mile in each direction, and I can be on the beach in 4 minutes after I get off the elevator. So. Could be worse.
Sounds terrible.
Yeah, it's horrible. It's such a terrible way to live. And my rent's I'm renting there, so I haven't even bought there, but my rent there is cheaper than my mortgage in Tennessee. Yeah.
And that's the thing. I mean, I think that's the dream for many real estate investors, and you're doing it. So that's great. That's super. So now if you had one piece of bulletproof advice for someone listening right now, what would you tell them?
Yeah, just don't wait. I mean, if you want to invest in real estate or anything for that matter, figure out how to buy back your time and do the things that are most important to you. This is something that I'm super passionate about. I have an entire Facebook community that I run dedicated to, we call it the last life ever philosophy. It's just about recognizing that we only get this one chance and you have to live the best version of your life. So we always tell people on our show and in our podcast and things like that is you owe it to yourself and really to your family, your community, and even the world to live that best version of your life. So, I love it if people join me there in the Last Life Ever Facebook group and check out our show as well.
Yeah, absolutely. Yeah, definitely check that out because I am a firm believer in that thought process. I mean, there was a time in my life when things were going really, really, really bad, and it took, almost losing everything to really refocus, and that's why we do what we do now. And it really, I'm trying to do the best I can, living the best life I possibly can too.
Yeah. So and that's the thing, everyone has their own definition of what that means. We're not telling you what is best for you, right? We're just saying we get this one chance and you're going to regret not going for those things that you want to do in life.
Yeah.
And the sooner you learn it, the better. And frankly, most people don't learn it until they go through something traumatic. I did not live the best version of my life before I got sick and thought I was going to die at 30. I'm actually very, very fortunate that I got sick and thought I was going to die at 30. Much like, you said you went through something difficult. Before that, you lived your life differently. And then you're like, hey, I'm going to reevaluate and figure out the way to live the best version version of my life. And that's going to change over time. Like we all have different priorities at different ages and stuff. And there's nothing wrong with working a job or running a business and working really hard. Like all that stuff is really good, but be aware of what you're trading for. Don't do it because, your dad was a doctor, so now you're a doctor or whatever, right?
Yeah.
And I think a lot of people do that. Like I went to law school, I think because my dad was a lawyer, and then I worked a job I didn't really like. And then when I got sick, I went bankrupt because I wasn't doing the stuff I really wanted to do in the first place. I might not have gotten sick, but I probably would have, but I definitely would have been in a better spot if I just pursued what I wanted to do in the first place.
That's right. Yeah. Well, good. All right, guys. Well, if you want to reach out to Jeffrey, reach him via his website at jeffreyholst.com. Check out his website, of course, his content. He's got a couple of great podcasts as well. You should definitely check out. Thanks for tuning in, and I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.